Welcome to the Deep Dive. We're here to cut through the noise and get you the information that, well, really matters.
That's the plan.
And today, we're plunging into something pretty fascinating. It's a high-stakes scenario involving Penco.
Oh.
They're a big global infrastructure player.
Right.
And they've got this major opportunity, a chance to complete a huge high-speed train line project in a country called Nurok.
But the question is it maybe too good to be true?
Exactly. And our mission today, it isn't just about looking at the headline financial figures, which might look quite impressive. We're really dissecting a real-world case here, trying to understand all those complex layers, the financial stuff, sure, but also operational, strategic things. What really drives a decision on a massive project like this one?
Yeah, what's really going on underneath?
We want to pinpoint what genuinely matters for a company like Penco in this situation.
Right. So for this deep dive, put yourself in the picture. Imagine you're right there in the boardroom. You've got all the reports spread out.
And you're trying to figure out, is this project a brilliant move? Or is it, maybe a potential trap? As we break it all down, think about what stands out to you.
Okay.
So let's set the scene first. Penco. They're a very successful company based in Aijai. Their home currency is the dollar.
Standard enough.
But they're properly global. Listed on major stock exchanges, operations all over the place. They're pretty substantial too. Market cap around $655 million plus $145 million in bonds.
So a decent size.
Yeah. And their nominal cost of capital, that's basically their minimum return needed on a typical project that usually sits around 10%, jumps to 12% for projects in developing markets. A bit more risk there.
Makes sense.
Their main business, building and laying train tracks, tram lines. Governments are their biggest customers. And they've built this really stellar reputation, ethical, always finishing complex jobs on time. That's important.
Very. And the project location is Nurok. Now, Nurok's interesting. It's a full member of the Eurozone, and it actually shares a border with Aijai, Penco's home country. What's really striking about Nurok is its economy. It's, unusually healthy compared to a lot of the Eurozone right now. It's actually growing.
Really? How come?
Mostly down to a couple of things. A low income tax rate, only 20%. And interestingly, companies can pay that tax up to a year after they earn the profits.
Ah, that helps cash flow.
Big time. Plus, the government there launched this major spending plan back in 2009, a 10-year commitment to upgrade the whole national railway network for these new superfast 2 trains. SPF2, they call them.
Gotcha. And Pencals wasn't new to Nurok, were they?
Not at all. They've had a wholly owned subsidiary there since 2009, right when that railway plan kicked off.
So they were in from the start.
Pretty much. They became a preferred supplier, providing specialist tracks, even doing consulting on laying and testing for these SPF2 lines. And up to this point, everything's been running smoothly. All the stakeholders seem quite happy.
Okay, so a good existing relationship. Now let's zoom in on this project, the final phase of that big railway upgrade. It's a 5-year job. Laying track on the Linus mountain range. And this isn't just any old mountain range, is it?
No, absolutely not. It's a national heritage site, dotted with small villages, sensitive area.
Right, so you can see trouble brewing.
And that's exactly where this project became what they called a special case. Because of the location, it immediately hit significant public scrutiny. Villagers, environmental groups, they were really concerned about ecological damage.
Understandably.
It led to a full public inquiry back in 2010. That inquiry actually delayed the project start, pushed it back to January 1st, 2014, and the outcome was crystal clear. Environmental factors had to be the top priority.
And that's why Penco got the nod, because of their ethical reputation.
Precisely. They were chosen specifically because they were seen as a company that would handle it responsibly.
Which means the Nurukian government isn't just paying the bills here. They're watching very closely.
Extremely closely. They've allocated extra resources, and they've openly acknowledged that this job laying track on the Linus Range is going to be, and this is their word, onerous.
Onerous. Doesn't sound easy.
No. And the financial and operational details are pretty specific, gives you a good picture of how it works.
Okay, let's get into that.
So the initial investment is huge, specialist machinery needed, costing a cool 1,000 million right at the start.
€1 billion.
Yeah. But here's a key detail. Tax allowable depreciation, Tad. You can only claim that on 250 million of the cost, not the full billion. And it spread straight line over the 5 years.
Okay, so that impacts the tax shield.
Significantly, and that public inquiry. It also set very specific targets for how much track needs to be laid each year. Different amounts each year.
Any particularly tough years?
Well, 2016 looks like the big one. They have to lay almost 11,000 meters that year. Way more than the others. So executing that year is critical.
Right. And how does Penco get paid?
Revenue side. The government pays 55,000 per meter of track laid. That's the rate at the end of 2014. And it increases by 3% each year after that.
Okay. Predictable revenue stream, sort of. What about costs?
Costs. Material and local labor start at $23,000 per meter, end of 2014, but those costs go up by 5% annually.
Faster than the revenue increase.
Exactly. Margin squeeze, like you said. Then there are fixed operating costs. They jump by $40 million at the end of 2014, and those rise by 6% annually. Even faster. Anything else? Yes, 2 more things. There's a royalty payment. A fixed amount, $15,000 per meter, goes back to the Penco holding company in IJAI each year. That's for the track technology they developed. It's seen as a fair arm's length value.
Yeah. An internal charge, but needs to be fair.
Right. And then working capital. Starts at 10% of the first year's revenue, 2014. Then it adjusts up or down based on sales changes. And importantly, it's all recovered right at the end of the project.
Standard practice.
And one final, quite significant point. The Narukian government has guaranteed to buy that specialist machinery back from Penco at the end of 2018.
Oh, for how much?
A nominal sum, 500 million.
€500 million. Guaranteed. That's quite helpful.
It certainly reduces the residual value risk.
Okay, right. Let's try and unpack this then. We've got euros, we've got dollars, costs going up faster than revenues, specific timings, a big guaranteed sale at the end. How on earth do you start putting a value on this whole thing for Penco back in IJAI?
Yeah, that's the core challenge, isn't it? International project appraisal. It's tricky.
So that's the process.
Well, first, you map out all those cash flows happening in Nuruk, in euros, year by year. Revenue coming in, costs going out, the initial investment, the final sale.
Okay. Then
you have to convert all those euro cash flows into IJAI dollars, Penco's home currency. That's where the exchange rate comes in.
Right. You mentioned the spot rate was 0.781 euro per dollar at the start, January 1st, 2014.
Correct. And crucially, you need forecasts for future exchange rates. The IJAI central bank expects the dollar to devalue by 5% per year against the euro, so you need to factor that changing rate into your conversions year by year.
Okay, that adds complexity. What about tax?
Tax is another layer. There's a bilateral tax treaty between IJAI and Nuruk. IJAI's rate is 25%, Nuruk's is 20%. Penco pays the 20% in Nuruk, but then potentially owes an extra 5% back home in IJAI on those profits. It's a differential tax.
Got it. So you calculate the euro flows, convert them to dollars using forecast rates, figure out the total tax, including the differential. Then what?
Then you have the projected dollar cash flows for Penco over the life of the project.
Okay, so cut to the chase. After you've done all that financial alchemy, what do the numbers actually look like? What are the dollar cash flows?
Right, the results. The initial investment translates to just over $1.3 billion going out. So $1,320.55 million at time zero.
Ouch. Big upfront cost.
Huge. Then the cash flows start coming back in dollars. Year 1, it's about $161 million. Year 2, roughly $165 million.
Okay, modest returns initially.
Then year 3, remember that big track laying year? It jumps significantly. About $425 million comes in. Year 4 is solid, nearly $280 million. And year 5, the final year of operation, is substantial. Over $1.1 billion. That includes recovering working capital and the machinery sale proceeds flowing through.
Okay, big finish. Is that it?
Almost. There's one final adjustment in year 6. A tax payment relating to the previous year's activities, about $19.6 million going out.
Right. So you have this stream of dollar cash flows, big outflow, then inflows increasing over time, peaking at the end, plus a final tax hit. How do you judge if that's good enough?
You need a discount rate. Because this project isn't expected to change Penco's overall business risk or financial risk profile, the right rate to use is their standard nominal cost of capital.
Which was 10%, right?
Exactly, 10%. So you take all those dollar cash flows, discount them back to their present value using that 10% rate.
And the big reveal.
The net present value, the NPV, comes out positive, plus $146.13 million.
So positive $146 million.
Correct. And based purely on that financial assessment, the conclusion is clear. The project increases shareholder wealth. It should be accepted.
Okay. A positive NPV of $146 million. That's pretty convincing on the surface.
It does.
But hold on. Experienced investors, people in that boardroom, they know that number, that NPV. It's only as solid as the assumptions it's built on, right?
Absolutely. You've hit the nail on the head. Every forecast relies on assumptions.
So what are the big ones here? The ones we really need to scrutinize, the potential weak points in this rosy picture.
There are several really critical ones we need to flag. First, all those inflation rates. We've assumed 3% for revenue, 5% for variable costs, 6% for fixed costs, constant for 5 years.
That feels like a big assumption.
It is. What if energy prices spike? Or labor costs accelerate faster in Nuruk? Similarly, we assumed IJI's inflation stays at 2.75% and the dollar devaluation holds steady at 5% annually against the euro. Any deviation there changes the dollar outcomes.
Okay, inflation and currency rates.
Yes.
What else?
Taxation. We've assumed the current income tax rates 25% in IJI, 20% in Nuruk, and all the allowances, like the depreciation rule, stay exactly the same for 5 years.
Which might not happen. Governments change policies.
Precisely. Tax rules can change, especially with budget pressures or political shifts that could definitely impact the net cash flows.
Makes sense. What's next on the list?
That guaranteed $500 million for the machinery at the end. The scrap proceeds.
You said it was guaranteed by the government, though.
It is, but think about it. This machinery has been doing onerous work, their word, on a mountain site for 5 years. What condition will it really be in?
So even with a guarantee, there could be disputes about whether it meets certain conditions, or maybe its actual underlying value is far lower, creating political friction.
That's possible. Or maybe the government tries to renegotiate despite the guarantee if its condition is unexpectedly poor. It's an assumption that $500 million comes through without a hitch.
Okay, good point. And exchange rates, you mentioned the forecast.
Yes, the exchange rates are a huge one. Forecasting spot rates 5 years out is notoriously difficult. We're using the central bank's 5% devaluation prediction, but global economics, political events, anything could throw that off course.
And if the dollar doesn't devalue as much or even strengthens,
then the euro cash flows translate into fewer dollars, potentially eroding that positive NPV significantly. It's highly sensitive.
Right, that feels like a major risk area. Anything else?
Yes, and it's a big one. The sheer size of this project relative to Penco.
How so?
The initial finance needed is $1 billion. That's roughly $1.28 billion at the starting exchange rate. Now, compare that to Penco's market cap of $655 million.
Whoa! The project cost is almost double their market value.
Exactly. The financial assessment just assumes they can raise this massive amount, presumably in the IJ financial markets, but can they? And at what cost?
Yeah, that raises huge questions. Does it strain their balance sheet, hurt their credit rating? Do they need to issue tons of new shares, diluting existing owners?
All of the above are possibilities. It's not just about profitability, it's about feasibility and the impact on the company's overall financial structure and risk. Is this project potentially just too big, too risky for Penco to swallow, even if the standalone NPV looks good?
That's a critical strategic question, not just financial.
Absolutely. And this is exactly where you'd want to run sensitivity analysis. Flex these key assumptions, inflation, exchange rates, even the scrap value, and see how much they have to change before that positive NPV disappears. How robust is the result?
Okay, so the shiny NPV needs some serious stress testing against these assumptions, especially the project size and the exchange rate forecast.
Definitely.
So what does this all mean for Penco then? We've got the core project, looks good financially, but with some shaky assumptions. But you mentioned there were other strategic elements too, things that could change the whole picture.
Indeed. There are two really significant strategic factors layered on top of the basic evaluation.
Okay, let's hear them.
First, there's this intriguing offer from a company called Elders, Inc. They're Nuruk's largest construction company.
Ah, a local giant.
Right. And apparently they worked closely with Penco on earlier phases of the railway project. And they were, let's say, a bit bemused, that's the word to use, that they weren't offered this final lucrative phase.
Okay, feeling left out. So what do?
They've made a formal offer to Penco. They want to buy the contract, lock, stock, and barrel.
Buy the project contract itself. When?
In 2 years' time. Specifically, on December 31st, 2015, they're offering $1,200 million for it. $1.2 billion.
Wow. So Penco could potentially start the project, run it for 2 years, and then sell it off for a guaranteed $1.2 billion.
Potentially, yes. This is what we call a real option. It's not a financial derivative, but a strategic choice embedded within the project itself. It gives Penco flexibility.
Flexibility to exit early if things look less rosy down the line, or maybe just take a guaranteed profit.
Exactly. Now, Penco's lawyers have checked. The Nurukian government contract doesn't explicitly forbid them selling the contract on, but
What?
Given the whole special case nature, the environmental sensitivity, being chosen for their ethical approach, Penco really needs to consider the ethical angle and the relationship with the Narukian government if they were to just flip the contract after 2 years.
Yeah, that could look bad. Reputation risk again.
Big time. But financially, it's an option. And you can actually put a value on this kind of flexibility. To do that, you'd need some extra financial data, like a risk-free interest rate, which is given as 4.5%, and an estimate of how volatile the project's future cash flows might be the standard deviation, estimated at 30%.
Okay, so there's a way to quantify the value of having that exit door available. Interesting. What's the second strategic element?
The second one circles back to that financing issue, the sheer size of the initial investment. Penco's CFO is, understandably, concerned about funding $1 billion when the company's market value isn't much more than half of that in dollar terms.
Right, we talked about that risk.
Yeah.
Is there a proposed solution?
Yes. A specific financing package has been put forward. A 1,000 million syndicated bank loan. It would be for 5 years, matching the project life, with an interest rate of 6.25%. And interestingly, it would involve Narukian banks.
Okay, borrowing in euros from local banks. Does that help?
It might align interests better. But here's the potential kicker. There's a hint that the Narukian government might provide a subsidy on the interest rate for part of this loan, maybe knocking it down to 4% annually.
A subsidized loan. That would certainly make the financing cheaper.
Absolutely. And getting a benefit like that, tied specifically to the financing rather than the project's operations, changes how you'd ideally assess the project's total value.
Careful.
You'd often use a different valuation method, like adjusted present value or APV. APV basically says, first, value the project based on its operating cash flows as if it were financed entirely with equity, using an appropriate discount rate for that. Then, separately calculate the present value of any financing side effects, like the tax shields from debt or the value of a subsidized loan like this one.
And you add that financing benefit to the base project value.
Exactly. It lets you clearly see the value coming from the project's operations versus the value coming from the specific way it's financed. It gives a clearer picture when you have these kinds of financing twists.
Okay, so the financing itself, especially if subsidized, could add significant value on top of the operating NPV we discussed earlier.
Potentially, yes. It's another important piece of the puzzle.
Right. So pulling it all together, we've got a project that, on paper, looks financially attractive. Positive NPV, $146 million.
Yep.
But it's resting on some significant assumptions, particularly around costs, inflation, and exchange rates. It's massive compared to the company's size. And it's ethically sensitive due to the location.
A fair summary.
Plus, you've got these strategic layers. The option to sell the whole thing off in 2 years to Elders Inc. and a potential specific, maybe even subsidized, financing deal involving Narukian banks.
It's a complex picture, isn't it? This deep dive really hammers home why, for major international investments, you absolutely have to look beyond just that bottom line NPV number.
Yeah, it's just the starting point.
Exactly. Factors like reputational risk, managing political relationships, the strategic value of flexibility, those real options, they are just as critical, sometimes more critical, than the raw financial projections. They can completely change the long-term success or failure of a venture like this.
So the final question for you listening in. When you're faced with a multi-million, or in this case, billion-dollar investment decision, how do you balance those hard financial calculations against the what-ifs, the ethical tightropes, and those strategic choices that could fundamentally alter your path?
It's the heart of strategic financial management.
Keep digging, keep learning. Join us next time for another deep dive.